Hello and welcome to Market Watch for the 4th of December 2017. Welcome to the last month of 2017 and a big month it's going to be. I'm only going to talk about this week, but be aware next week is ginormous. We have the Fed and we will very much cover off on what likely is to happen around that meeting, rate movements, new chairman, all that kind of stuff we'll cover off next week. But let's concentrate on this week, which will be just as big. There is economic data, there are central banks, there's all forms of basically forecasts for 2018 and all of the close off for 2017. So it's a really big week and certainly will be quite interesting. It could push markets around quite interestingly as well. So let's start with what happens on Tuesday. RBA, clearly you can't go past it. 2:30, look at Martin Place. Three things to really watch out. How much emphasis they put on wage growth, how much emphasis they put on inflation. Clearly that will be the big two. I also want to hear what they talk about growth as well. We've actually started to see other signs outside of net exports that show that growth is probably going to come in 2018. It's the consumption side that they may highlight on the back of the other 2 points being inflation and wages. Big core piece of data. Same day, you do get also the retail sales numbers. Always an interesting one for those of you that quite like watching things like discretionary and also the Aussie dollar. It's been pretty anemic for probably the last 25 months, so don't expect anything brilliant. It's for October too, and we know that October was quite stodgy. We heard that from pretty much most of the discretionary plays. Look at Premier, look at Myer, look at JB Hi-Fi, also Harvey Norman. They all told you the same thing, that October was pretty stodgy. So just be aware that it may be a negative read beforehand at around about 11 a.m. and then looking towards that meeting in the afternoon at 2:30. Tuesday night, for those of you that may want to look overseas, there are European and also Canadian data. The Canadians are meeting at their central bank. Again, not a huge impact on our market, so I'll leave that. But we do get European GDP, and that may also be something just to sort of keep in the back of your head because we are looking at global growth. And if global growth is expanding as forecasted, that filters through on an indirect basis. It goes from China, comes back to us as well. So please just keep an eye on that because if Europe is ramping up, it's the second largest exporting economy for China. That's a real big tick as well and could be a positive. Looking to Thursday. Thursday is also a fairly big day in terms of data coming out of China and also here. You get the trade balance coming out of China. The Chinese trade balance has been pretty reasonable and it continues to show some really decent strength. You've also got things like fixed asset investment, retail sales. Here in Australia, you get building approvals. You also get things like inflation reads around building indexes. All that's sort of a big mover on Thursday as well. But what I want to concentrate on and what will therefore lead into next week is Friday. And Friday is the last non-farm payrolls of 2017 to really get your sort of teeth into, to really understand if full employment in the US is coming on. What we heard from Jerome Powell last week was really interesting, is that he clearly is trying to find caveats that he can point to that maybe will slow down their gradual rate rise to glacial. And that certainly will therefore mean looking at the non-farm payrolls. Headline numbers will be strong. What he's now starting to emphasize, and even Janet Yellen herself in the back end of her tenure has been emphasizing that, like here, wages aren't expanding. So that's where they measure on the hourly average wage number growth. And that is on a year-on-year basis. And it's been pretty anemic as well. And just keep an eye on that. Yes, they're going to raise rates next week, but if he gets that sort of idea that he could possibly continue to keep the economy expanding at a reasonable rate, as his words were saying, without having to change monetary policy, that might be another thing as well. And that will definitely push markets around if there are signs that they're not going to move rates as fast as they were expecting in 2018.